If you're retired and living on Social Security, a pension or savings you worked your whole life to build, what I'm about to share could protect you from a mistake that has cost some retirees thousands of dollars, sometimes even triggering IRS penalties as high as $10,000. And here's the part that should get your attention. Many of the people who ran into trouble weren't hiding money. They weren't committing fraud. They were simply moving their own money between accounts, depositing cash from a sale, or helping a family member. Completely normal activity, yet months later they received letters from the IRS asking questions. Let me explain why this matters. There are certain types of bank activity that automatically get reported, not because you did anything wrong, but because federal reporting rules require it, and when those reports don't line up perfectly with what appears on your tax return, that's when confusion and sometimes penalties begin. Before we go further, if you appreciate calm, clear explanations about Social Security, IRS rules, and retirement finances without panic or rumors, consider subscribing. I focus on steady, factual updates so you can make decisions with confidence. Now let's talk about the specific activity that can create problems. You've probably heard about the $10,000 rule. Many retirees believe that if they deposit more than $10,000 in cash, the IRS automatically penalizes them. That's not exactly how it works, but this is where many people get confused. Banks are required to file what's called a currency transaction report for cash transactions over $10,000 in a single day. That doesn't mean you owe taxes. It doesn't mean you're in trouble. It simply means the transaction is documented. But here's where things become risky. Some people, after hearing about that rule, try to avoid it by breaking deposits into smaller amounts. Maybe $9,000 one day, $8,500 the next. They think they're staying under the radar. That behavior is called structuring, and it can trigger serious penalties, even if the money is legitimate and belongs to you. Yes, even if you were just trying to avoid paperwork. The penalty for structuring can be severe. In some cases, civil penalties alone can reach thousands of dollars. And if the IRS believes there was intentional avoidance, fines can climb much higher. Now pause for a moment. Think about how many retirees handle cash. Maybe you sold a vehicle for $14,000. Maybe you sold jewelry. Maybe you withdrew cash over time from a safe deposit box. Maybe a relative repaid you for a personal loan. Maybe you received cash from a small side business you run in retirement. Those situations are not illegal, but if deposits don't match reported income, IRS computers can flag discrepancies, and today, those systems are more automated than ever. Here's what this means for you. It's not the deposit itself that creates the penalty. It's the mismatch between what the IRS sees from bank reporting and what shows up on your tax return. Let's say Robert in Arizona sells a used RV for $18,000 in cash. He deposits $9,000 on Monday and $9,000 on Thursday because he thinks staying under $10,000 avoids reporting. The bank may still file a suspicious activity report because of the pattern. Months later, Robert receives a letter asking him to explain the deposits. He panics. He didn't report the sale because he believed it was personal property and didn't realize there could be tax implications. Now he's not just explaining income, he's explaining deposit behavior, and that's where the situation escalates. This is not meant to scare you, it's meant to inform you. Another common situation involves retirees moving money between accounts. You might move $12,000 from savings to checking to pay for a roof repair. That's not taxable income, but if paperwork isn't clear, or if there are multiple institutions involved, it can appear as incoming funds. Add to that the rise in digital payment apps, online marketplaces, and peer-to-peer transfers, and reporting has become more layered than it used to be. Even small businesses run from home, woodworking, crafts, tutoring, can trigger forms like 1099-K if payments cross certain thresholds. And if you forget to include that income on your return, even accidentally, the IRS can assess penalties for underreporting. The standard accuracy-related penalty is often 20% of the underpaid tax. But if the IRS determines there was intentional disregard of rules, penalties can increase significantly. In extreme structuring cases, penalties can exceed $10,000. That's why this conversation matters, especially for retirees on fixed income. When you're living on Social Security and maybe a modest pension, an unexpected tax penalty doesn't just hurt, it disrupts your entire annual budget. A $10,000 penalty could wipe out months, even years, of savings cushion. And many seniors who face these notices say the same thing. I didn't know. Let's be very clear about something. Your regular Social Security deposit is not the problem. The Social Security Administration issues Form SSA 1099 each year showing exactly what you received. That's already reported properly. The issue arises when additional bank activity doesn't clearly connect to what's filed on your return. Selling assets, receiving large cash gifts, making frequent cash deposits, breaking up deposits, running a small side income stream, withdrawing large retirement distributions without understanding the tax impact. Those are the areas where confusion happens, and confusion is expensive. You also need to understand that IRS enforcement today relies heavily on automated matching systems. Computers compare what banks report, what payment platforms report, and what you report. If numbers don't align, the system sends notices automatically, not because you're being targeted, not because you're suspected of a crime, but because the data doesn't match. And for retirees who haven't dealt with business-style reporting rules before, that mismatch can feel overwhelming. So here's the foundation you need to understand before we move forward. Bank reporting is about documentation, not automatic punishment. Penalties happen when income is underreported, when structuring patterns appear intentional, or when required forms aren't filed. The goal is alignment and transparency. If you move money, keep records. If you sell something significant, document it. If you receive income, even part-time, understand how it's reported. In retirement, many financial activities change. You might downsize, sell property, help grandchildren, liquidate investments, withdraw larger sums for medical costs. All of that creates transactions that didn't exist during your working years. And the IRS doesn't see context. It sees numbers. Now let's connect the dots between your bank activity and the income the government already knows about, because this is where many retirees get surprised. Every January, the Social Security Administration sends you a Form SSA 1099. That form shows the total benefits you received during the year. The IRS gets a copy. When you file your tax return, the numbers are matched automatically. If you receive a pension, you get a Form 1099-R. If you take money out of a traditional IRA or 401k, you get a 1099-R for that too. Again, the IRS gets a copy. If you work part-time, your employer sends a W-2. All of that is already tracked. Your regular Social Security deposit hitting your bank account every month is not suspicious. It's expected. It matches the SSA 1099 exactly. Here's what this means for you. The problem usually starts when money shows up in your account that doesn't have a matching tax form, or when you receive a tax form and forget to report it. Let's walk through some very real retirement scenarios. Imagine Linda in Florida. She's 68. She receives $1,850 a month in Social Security and a small teacher's pension. Last year, she decided to sell her old camper for $18,000. The buyer paid her with a cashier's check. She deposited the full amount. From her perspective, she just sold personal property. But here's the technical side. If she sold it for more than she originally paid, there could be a taxable gain. If she sold it for less, there's usually no deduction for personal losses. But either way, the IRS doesn't automatically know the cost basis unless she reports it. So when $18,000 lands in her bank account and it doesn't align with her known income sources, that deposit may not cause a penalty. But if she receives a notice asking about unreported income, she must be able to explain it. This is where many people get confused. The IRS taxes income, not deposits, but deposits are often used as a starting point during reviews. Now let's talk about retirement withdrawals. Required minimum distributions, RMDs, apply once you reach the required age under current law. If you're required to take $12,000 out of your traditional IRA, and you do, that amount is taxable income. You'll receive a 1099-R showing the distribution. If you forget to include that 1099-R on your return, even accidentally, the IRS computer system will catch it. You might think, but I paid the taxes automatically when they withheld some. That doesn't matter. If it's not properly reported, you can receive a notice assessing additional tax and possibly a 20% accuracy-related penalty on the underpaid portion. Now let's look at part-time work and side income. Many retirees supplement their income. Maybe you sell crafts online. Maybe you tutor. Maybe you drive occasionally. Maybe you sell items on online marketplaces. Payment platforms now issue Form 1099-K when certain thresholds are met. Those forms report gross payments processed through the platform. Notice that word, gross. That means the total amount before expenses. If you receive a 1099-K for $7,500 and only made $2,000 in actual profit, you still must report the income and then deduct allowable expenses properly. If you ignore the form because you didn't really make that much, the IRS system only sees the 1099-K amount. Mismatch. Letter generated. This is not rare anymore. Digital reporting has expanded dramatically in recent years. The IRS relies on automated matching. If a form exists under your Social Security number and it doesn't appear on your return, it creates a discrepancy. Let me explain why this matters, especially for those receiving SSI. Supplemental security income has strict income and asset limits. Even small amounts of side income can affect eligibility if not reported correctly to the Social Security Administration. SSI is different from retirement benefits. If you're on SSI and receive additional deposits, even irregular ones, you must understand how they impact your monthly benefit calculation. For SSDI recipients, there are work limits tied to substantial gainful activity. Bank deposits reflecting earned income could trigger reviews if they exceed thresholds. This is where many people get confused. The bank does not decide your taxes, but the information trail connects agencies. Now let's address stimulus payments and state relief programs. Federal stimulus payments issued in past years were not taxable federally. They did not create additional taxable income. State relief checks vary by state, but many were structured as rebates, not taxable income. Still, documentation matters. If you receive a state senior property tax rebate, keep the letter. If questioned, you can show it was a rebate, not income. Here's another example. George in Ohio withdraws $25,000 from his IRA to help his granddaughter with college tuition. He knows it's taxable, but he forgets to increase his withholding. At tax time, he owes more than expected. He files late because he doesn't have the money ready. Now penalties and interest start accumulating. Failure to file penalties can reach 5% per month of unpaid taxes, up to 25%. Failure to pay penalties add more. It doesn't take fraud to reach thousands of dollars in added costs. It takes misunderstanding. Another situation involves gifts. If your son gives you $15,000 to help with medical expenses, that gift is generally not taxable income to you. The reporting responsibility, if any, falls on the giver under gift tax rules. But if that money is deposited and later mixed with other transactions, you need documentation to explain the source. Again, deposits are not automatically taxable, but unexplained deposits raise questions during reviews. Let's talk about moving money between your own accounts. If you transfer $20,000 from one bank to another, that is not income. But during an audit, the IRS may ask you to distinguish transfers from income. If your records are messy, it becomes harder to show that it was simply a transfer. Clean documentation solves that quickly. Messy documentation prolongs stress. Now think about budgeting. Many retirees operate on tight margins. Social Security payments follow a schedule based on your birth date. If you started benefits before May 1997, payments typically arrive on the 3rd of the month. Others receive payments on the 2nd, 3rd, or 4th Wednesday, depending on birth date. Those deposits are predictable. Unexpected deposits are not. And when unexpected deposits combine with unreported 1099 forms or large retirement withdrawals, that's when IRS notices appear months later, often long after the money has been spent. Here's what this means for you. It's not about being afraid of your bank. It's about understanding that the IRS matching system connects forms, income, and reported numbers automatically. If you sell something significant, ask yourself, is there a gain? If you take a distribution, ask, is enough tax withheld? If you receive a 1099K, ask, did I report the gross and deduct expenses properly? If you receive SSI or SSDI, ask, does this deposit affect eligibility rules? Clarity prevents penalties, and when clarity is missing, small oversights can snowball. Now let's talk about protection, because once you understand how these penalties happen, the next step is making sure they don't happen to you. Here's what this means for you. The goal is not to avoid your bank. The goal is to keep clean, simple records and make sure what goes into your account matches what goes onto your tax return. First, keep documentation for any large deposit. If you sell a vehicle, keep the bill of sale. If you receive a gift from family, keep a written note or transfer record. If you move money between your own accounts, label transfers clearly in your records. That way, if a question ever comes, you can answer it calmly and quickly. Second, report every tax form you receive. If a 1099-R shows a retirement distribution, include it. If a 1099K arrives from an online platform, don't ignore it, even if your actual profit was small. Report the income properly and deduct legitimate expenses. Accuracy prevents automatic notices. Third, understand your required minimum distribution rules. Missing an RMD can trigger steep penalties. Taking one without planning for taxes can create an unexpected bill. Review your distribution amounts each year and adjust withholding if needed. Fourth, if you receive SSI or SSDI, report changes in income promptly to Social Security. Even temporary or small earnings can affect eligibility calculations. Staying proactive prevents benefit adjustments later. And let's address something clearly. Your regular Social Security retirement deposit is safe. It is reported properly through SSA 1099 forms. There is no hidden IRS trap attached to your monthly benefit. Discussions about long-term funding happen in Washington, but today's benefits are being paid under current law. The risk we're talking about comes from additional bank activity that isn't clearly documented or properly reported. Now, before we close, let me summarize the most important takeaway in simple terms. Deposits are not automatically taxable, but unexplained income, unreported tax forms, and intentional deposit structuring can trigger penalties, sometimes reaching thousands of dollars. Clarity and documentation are your protection. If you ever receive an IRS notice, don't panic. Read it carefully. Most letters are requests for clarification, not accusations. Respond on time. Provide documentation. If needed, speak with a qualified tax professional. Acting quickly reduces additional penalties and interest. Retirement should be stable, predictable, secure. You worked decades to build this chapter of life. A preventable paperwork mistake shouldn't disrupt it. Stay organized. Report income accurately. Keep copies of major transactions. Review your tax return before filing. Small habits make a big difference. And if you're comfortable sharing, let me know in the comments which city and state you're watching from. Tax rules and state programs can vary, and your experience may help someone else avoid confusion. If you've ever received an unexpected tax notice and resolved it, your story could reassure another retiree who feels overwhelmed. You are not powerless in this. You just need the right information, and now you have it. Stay steady, stay informed, and protect the retirement you earned.